Appreciate you checking out another video from NetPicks. And today I'm going to talk about the daily time frame. And I'll be honest with you, daily charts are probably not going to be the time frame for you if you are looking for fast market price action. Okay, because you have to wait until the end of the trading session to make your trading decisions on whether you have a setup or not. And for Forex traders, for example, this could be hard because markets trade differently than stock markets or futures because they have clear start and end times. Now, you're not going to have as many trading setups on the daily time frame as you would on intraday charts, of course, such as a 5-minute or a 15-minute chart. See, but here's the thing. Many traders, when they get into trading, they want to jump right into the fast world of day trading before they can even make a success at trading the daily chart. I don't think it's a smart thing to do for a lot of people. Now, the daily time frames. Why would a casino hate it? Well, let me tell you, I used to love trading lower time frames, okay, because I believed that the more trading opportunities there were, the more money I'd make. Well, besides not paying attention to the transaction costs, I realized that I was becoming excited about the next play, just like when you're at a casino. Like, it felt really good having a winning trade, and I sometimes felt that the next trade would be a winner. I ignored what we call at NetPicks the power of quitting and was actually excited about how quickly I could win money. But the thing is, the losses, they're real. I would just keep plugging away, thinking, well, here comes that winner. Just like a gambler does. And I tell you right now, that was a big mistake for me. So the daily chart, using the same trading strategy, the opportunities to trade were less. And to be honest, it was a test of my patience. But in time, though, I learned that not every day is going to produce a trade. That instant gratification of having a few quick wins, it started to fade. So no longer was I just picking up coins here and there. I began to work less for better results, and I was actually losing that casino mentality. And quite frankly, I think I'm better for it. At the 15-minute time frame would have quite a few setups for most strategies. Looking at the daily chart, we can see a simple pullback pattern trade setup, and it triggers long. There's less trading opportunities, but I find that the price action is a lot more clear. So what are the 4 best things about trading the daily time frame? And I can really only speak from my experience about what I think are the best things. But I'm sure that a lot of you will find it pretty enticing as well. Number one, there was more time to make decisions, right? So there's less pressure. So instead of watching every single price movement, I can actually come in later in the day. I can look at the charts to see if my setup is becoming clear, right? So getting a clearer picture of the market actually gave me time to objectively see if my setup was there or not. I do it once a day, and I can actually quickly scan through a lot of charts to find a setup. I'm not really on the clock to get my orders in as quick as possible before that price takes off. So the urge to jump in on a fast-moving market, as you see on smaller time frames, I don't find that a problem on the daily chart because it takes a full session for that candle to close. And unless I'm using limit orders, I only need to think about the closing price and where it is on the chart. So here, using a basic pullback approach and standard trend lines and support and resistance areas, you will quickly know if there's a setup or not. Every single day you can do it. Now, the red X, they're examples of days that it would take you about 3 seconds to see if the trade's present. Now, the green check marks, they would actually have you stopping and spending some time on the chart to ensure that it meets your specific set of criteria, right? You just run through your list of your trading plan and you enter trades according to your plan. I found less trade frequency gave me better odds. Now, I don't need to spend every waking hour staring at the screen because I know what time to come in to look at the market for my setups. Now, even though I did try to stick to a day trading schedule with specific stop times, I just didn't want to miss that big move. On the daily chart, I find setups lead to bigger runs. On the smaller charts, adverse price action would actually violate my trade, while an entry on the daily chart would still be valid. So having a large margin for price action against my position gives price time to work in my favor. And yeah, there's times that I enter on a daily time frame and I would see adverse action right after my entry. But since the stops are further away, I'm actually able to manage the trade to limit the overall percentage of the accepted risk. Now, my overall win rate went up, and risk was not exposed to the market as often. My overall return increased with less time in the market. So the less trading I do, the less I'll pay in transaction costs. And, maybe a few dollars here and there. It doesn't seem like a whole lot, but over time, that really adds up. News and data releases, they don't influence you as much. And I remember when I started to trade Forex, being lured into trading the non-farm payroll. Now, those fast spikes, they looked really good to trade. But oftentimes, the slippage I'd get just were not worth the effort. And you could add to that any lag in your data or your order entry. It just ends up costing you profits. Now, with the daily time frame approach, the news or even spread widening that happens by brokers has little effect on the trading position. Now, here, most Forex traders, actually any trader in markets, will generally use swing highs and lows for their stops. And you could bet on this chart here that many traders were taken out of their positions on these two spikes at the extreme of a trading range. And you get to focus on the process of trading. So the daily time frame, it actually gives you time to work through your trading plan, gives you time to learn to let your profits run, and time to pursue other streams of income. But now, you don't need to have a full-time job before you choose to use the daily charts. And a quick note, one thing I find amusing are people who say, well, why make trading videos or sell products when you make money trading? If you have time to have another stream of income, why would you not do it? See, this is why we see a lot of people take up trading while they have another job, because they understand the concept of not putting all your eggs in one basket. Now, longer term trading, whether it's swing trading or position trading, it's not going to have you reacting to every single blip on the screen. And traders who choose a longer term approach begin to harness the ability to let their profits run. They don't scalp out small little profits while they take big losses. Now, there's a drawback, though. You may, depending on your stop loss approach, give back more unrealized profits as price pulls against you. That's a trade-off. But in time, you're going to learn that sticking to the plan that you designed was always the best way to go. So I want to give you a simple daily time frame strategy for any market, really. And I don't want you to be deceived by how simple it is. Okay, you're going to use two trading indicators. One is a 20-period simple moving average. The next one is a 5-period ATR, okay, the average true range. Trading rules are as follows, and these are for buys. You want to wait for price to break above the 20-period moving average. You want to see two candle lows plot completely above the average to point out a trading signal. Now, after that second low plots, you place a buy stop order at 20% of the ATR above the high of the highest high of those two candles. You set your stop 20% ATR from below the price of the moving average when you enter the trade. And you just trail your stop using the moving average. And let's take a look at this example on the daily chart. This is the Aussie USD. So we can see that price is broken above the 20 SMA, and we need our two lows above the average. Now here on completion of the second candle, we can see it is in the second low above the average. So we place a buy stop order at 20% times the 5-period ATR. Now the initial stop loss is placed at the value of the moving average minus 20% of the 5-period ATR. All you're going to do is trail your stop at 20% times the 5-period ATR below the moving average as it starts to move. And here the first trade will exit at 146 pips from the entry. Now you don't see a setup to the downside, but we do get another valid buy setup. You just follow the same approach as you did for the first trade. Now let's look at other setups, and this is a different market. You have to accept losses in trading. Okay, and the first trade's a loss when price actually retraced 4.5% from your entry. Basically, no sooner had you entered and you had immediate price reversal, hit your stop loss. The next setup does not trigger, and for those that understand price action, you may have actually skipped that trade due to the momentum move to the downside. Oftentimes you look at snapbacks in prices when that happens. We then get trades that don't trigger because we're using the ATR buffer. And finally, we get a long setup of triggers. And right now, it was currently up 38% from the entry price at this chart. What about working around support and resistance? Now, I'm not one to make tweaks just to avoid a loss. However, there are some merits in considering the structure of price. So when we see price flipping around the moving average like this, it's basically a sign of a trading range. Now, the first trade on the left, that's a valid trade. But price will eventually pull back and it'll stop you out. But it's actually less than the initial risk. So that's not a bad thing. Price begins to put in action, that begins to range. Just marking off the highs and lows of that immediate range can help avoid being in trades that immediately reversed. Now, some traders may have begun to expand that range. If you did adjust by doing that, price would have to travel far from that 20-period average price, and that can lead to a snapback in price. It would be a 2-second analysis of this chart to have you decide to step aside from a crude oil chart, that's what this is, and onto another instrument. So let's wrap this up. Using the daily chart, I find personally is less stressful. Coming into check the market once a day or twice a day, whatever, set your orders, check the next day. That allows you to focus on other streams of income. And understand that in some markets, using the moving average as your stop loss location can be a little rich for your account size. So ensure you trade markets where you can afford the risk. Okay, for many people, that would be Forex because you have that flexibility in position sizing. Thanks for watching. Any questions, comments, pop them below. Make sure you like this video, subscribe, and we'll talk to you soon.